Welcome to the Daily Update, where I'll go over the action in the market for Monday, August 14th, and then we'll see how things look for Tuesday, August 15th. We're still holding above the 50-period moving average on the S&P 500. Is that going to be enough support to be able to turn things around and look more positive? We did have an up day. It was mainly the mega caps that led stocks higher, so we didn't see a real broad participation, but we are seeing a little bit of improvement nonetheless. We're still oversold in the short term and negative. We're still negative in the intermediate term, and we're still positive in the long term. But we're at that point where the market has a chance to recover if it wants to go higher, or we could continue to go lower if that's what it decides it wants to do. First, be aware that I am planning an online course in September. It looks like I'm going to do multiple shorter sessions. I'm looking at possibly doing a Tuesday, Wednesday, Thursday, about lunchtime, Eastern time. I haven't actually nailed down the date yet. I'll be covering my approach to technical analysis. I might have some insights that you feel are interesting. I'll be going through some very basic ideas about strategies, as well as talking about support and resistance, mainly on an end-of-day level. Let's go back and talk about what happened. Right at the open, we had a lower open. We were below the daily pivot at 44.61. Then we climbed back above the daily pivot and got above the unchanged level, and we actually went above R1 at 44.79. Then prices chopped above and below R1, and we closed at the high, but we didn't get all the way up to R2 at 44.94. We closed below that. We were up 0.58% on below average volume. That's summertime action that's taking place right now. So to see below average volume has become the norm these days. The technicals, as I said, were still negative in the short and intermediate term, positive in the long term. The markets are fixated on inflation and interest rates, but right now we're more technically focused to see if we can maintain some kind of support. Mega caps did outperform, which helped the S&P and NASDAQ 100. Interest rates are still going up. Now, if they keep climbing, that might spook the markets. The S&P is still above its 50-period moving average, but we're still underneath 4,500. On a short-term basis, our list is a little bit shorter. We have the Stochk RSI, the CCI 20, and the stochastics that are extreme negative, but they have more room to fall if we're going to continue to decline. If we keep going up, the list should become shorter. The dollar was up and interest rates were up. Now, this usually provides a headwind for stocks, but it didn't do that in Monday's session. All of the yield curves that we follow are still inverted. We had the 30 to the 5 that went back to being normal. Now it's gone back to being inverted. Sentiment is still positive. We ticked up to 66 where we had been at 65. Our trend is positive. The green line is starting to advance, so that's looking a little bit more positive, but the ADX is weakening. It's below its moving average, but they're still above 20, suggesting that we're in a trending environment. Because of the update, our bias is positive, and I've switched our momentum now to mixed, even though we're negative technically. We did not have any economic reports that were released, and there's no charts to show you. Looking at some isabelnet.com blog charts, this says years with the big first half tend to consolidate around now. When the S&P is up 10% or more at the end of June, the first half of the year, we tend to see some sideways to slightly declining action right at about now. So this is not necessarily a surprise. The takeaway from this chart, you could read this for a while, but I would just take away the headline. The latest inflation data support our expectation from Goldman Sachs that the core trend will have slowed enough by November for the FOMC to conclude that a final rate hike is unnecessary. Now, this could change at any time. But people like to look at this stuff. They think they get answers from it. We just tuck it in the background and just know this is one scenario that's possible, realizing that things can change at any time. Also, looking at sentiment, we're still in the positive area after we had been showing extreme greed, according to this chart. Our other sentiment indicator is now starting to drop down. It had been extreme positive, and it's starting to pull back. Looking at sector fund flows, we're still seeing money going into tech and coming out of energy, but it's turning back up a little bit as we've been seeing energy bounce up recently. Bank of America still sees a lot of money going into Japan and investment-grade bonds. They still see a lot of money coming out of growth as well as a lessening of bank loans. The exposure to equities, meaning stocks, it has dropped off a little bit as the market's hit a snag lately. Bond fund flows by category the last 4 weeks, where we're showing all bonds over here on the left, and then the different types of bonds where money is flowing in. It's kind of interesting here that we had been seeing a lot of money going into mortgage-backed securities. That kind of got tagged as the real danger point that led to the financial crisis back in 2008. What's the terminal rate right now? We're thinking just a little bit over 5.4% before the Fed tops out and then starts to bring rates down. Cumulative flows into equity by different regions. We're seeing money coming back into the U.S. Europe is trailing off a bit. Emerging markets are seeing a continuation of funds flowing in, but we're seeing a lot of money going into the Asia-Pacific areas. Even though they're having some trouble in Japan specifically, folks are still continuing to put a lot of money into those markets. A couple of charts that I ran across, this goes back into the 60s and into the 70s and shows the CPI. The yellow line is what already happened. The orange line is what's happening now, and we're seeing a pretty good correlation. I'm not a big fan of putting these things on top of other charts, but sometimes they can still be useful. We want to see these things, but not necessarily make decisions based on them. If we follow this same basic pattern, we do see inflation starting to come down, but then after that, we see a real spike of inflation if you remember the late 70s. The S&P 500 comparing 1966 and 67 with 2022 and 2023, this is what was happening between 1966 and 2022. You can kind of see a correlation here. And we don't know what will happen after this, but here they have an arrow saying that you are here, where we see some weakness and then possibly some strength coming into the market after that. Getting into our charts and analysis intraday, where we did have a lower open, not much of a gap. We opened below the daily pivot. We came back above the daily pivot, above the unchanged level. We got up above R1, and then we chopped sideways, going above and below R1 for most of the session. And we saw a little bit of strength going right into the close. Intraday, where we were flat in the initial overnight session on Friday, we did open higher in the Sunday afternoon session. Then we saw some weakness going into the open. Then that was followed by strength during the cash session. We closed pretty much at the high, and we're seeing a little bit of strength in the initial overnight session. Looking at growth versus value, growth had a fairly good day. It did outperform value. So on a closing basis, growth was up more than value for the large caps as well as the mid caps, and it was down less for the small caps. Here's the growth to ratio chart for the S&P, where it spiked up right out of the gate, and this is giving some good support to growth stocks, which could be positive for the market. After we came up to a high level, we trailed and pretty much went sideways for the rest of the session. Looking at sentiment, our Ulcer Index is continuing to climb, suggesting that more fear is coming into the market. When we look at the VIX, we did decline with the line chart as well as the bar chart. The VIX of the VIX is also showing that volatility is coming down slightly. We look at the VIX to a 3-month average of the VIX and then take a ratio. We're watching this red line, and it's starting to turn back up, showing that there is some fear coming back into the market. We saw a real spike up with the VIX to move ratio last week. Well, it really dropped below its moving average in Monday's session. And then the VIX to the VVIX ratio, we're watching this. This is longer term. We topped out and started to come down when we hit the lows back in 2022, and we've been declining since that time. Now we're getting a little bit concerned because we're seeing this ratio starting to turn back up. Is it going to roll over and continue to fall, or is it going to continue to head higher? If it keeps going higher, that would be negative for the markets. Looking at the 5-period simple moving average of the equity put-call ratio, this is a concern because it's continuing to rise, and it goes in the opposite direction of stocks. Longer term, we're also seeing this ratio continuing to go back up. We're turning up just slightly with our 253-period simple moving average. Although we have been declining lately, we want to know, is this going to continue to decline, which would be positive, or is it going to start to go back up, which would be negative? Looking at one fear gauge, we ticked down just slightly on this chart, and we ticked down as well on the other fear gauge that we look at. The ratio between risk on and risk off did bounce up a little bit. We're seeing more of a short-term decline here after we had been seeing more of an intermediate-term advance. Our advanced decline line studies, we were pretty much flat based on price. We declined a little bit based on volume. The new highs, new lows were declining with the 5-period and the 10-period, and the new highs and new lows were pretty much even in Monday's session. This is possibly encouraging. We're seeing the accumulation distribution starting to come back above this moving average. This tries to measure what the smart money is doing. If we see follow-through strength in this indicator, that could be positive for the market. We're also split right now with our advanced decline line ratio. In the shorter term, we're below zero. In a longer term moving average that we use, we are above zero. The cumulative NYSE advanced decline line did show a little bit of weakness. The broader market was weaker than the mega caps. We also saw a bit of a decline, but we're still above this trend line. Here's another look also showing that we're above the trend line. The common stock, based on price, we did see a decline and a little bit of a decline based on volume. We also have this longer term negative divergence that's working in the background. Our advanced decline line studies, we did decline with the NYSE. We were pretty much flat with the S&P. Mid caps were flat and we saw a decline with the small caps. However, all of the indexes continue to be above their moving averages. Our trend, this is where we're turning potentially more positive. The green line is starting to come back up, so we default to the positive that way. However, the ADX is below its moving average and declining. That suggests that there's a weakening trend. If we chop sideways, it would not be surprising to see this ADX drop below 20, suggesting that we're going from a trending environment into a non-trending environment. Short term, we are in a non-trending environment, but we're turning a little more positive with the green line going up. The ADX is weakening. So in the short term, we're chopping. Intermediate term, we're still in a weakening trend. Volume continues to drop off as we endure the summer. Our short-term charts, we came down to the 50-period moving average and down to this pivot level, and so far we've been bouncing up off of that. Is this going to be a turning point for the S&P 500? On the bottom, you see where volume continues to drop off. We're dropping below the 20-period moving average, and if we keep going up, it may offer some kind of overhead resistance. We want to break through this and close above it to turn more positive. Our rainbow, we're coming down into the rainbow, but we're seeing a little bit of a bounce now. With our shorter term moving averages, they are starting to roll over a little bit. The longer we stay in this rainbow, the more ruffled this rainbow will become. Looking at our moving average study, we ticked down just slightly with the 20, 50, and 200 period moving averages. The Stochc RSI, even though it ticked up, is still extreme negative. The CCI 20 ticked up a little bit, but is still extreme negative. The stochastics, coming out of being extreme negative in the short term, we're still extreme negative in the intermediate term. Long term, we're continuing to look negative, and we're crossing below the midpoint. The force index showed a little bit of an improvement, but is still negative. Some intermediate term charts. The balance of power is just about at the dashed line now, showing a little bit of improvement, but right now that's neutral. The go-no-go system is kind of going crazy here. We're still positive with the blue bars, but when we turn a lighter shade of blue, that's more neutral positive. The highest high and lowest low value, we did bounce back up, but we're still below a declining midpoint, and the highest high value is still going sideways. Our standard deviations, we have not made it back up to the midpoint yet, even though we're seeing a little improvement with this chart. We came down almost to the 50-period simple moving average, and so far it looks like we're bouncing up off of that. Is this going to continue? Also seeing the same thing with our moving average tree, down to the 50-period simple moving average and bouncing so far. Here's the intermediate term rainbow. We're coming right down again to the 50-period moving average, and so far this level is holding. Looking at the ease of movement, we continue to be negative because we're below zero. The Erin was pretty much flat on Monday based on Friday's session. We're seeing a decrease in the buyers as well as a decrease in the sellers as volume has really been dropping off. The McClellan oscillator was pretty much flat, but it's still below zero, so that calculates into the summation index where we're declining based on price and volume. The NYSE McClellan oscillator also below zero and declining. So the NYSE summation index based on price is declining as well as based on volume. This is a little bit of a warning sign. On Thursday and Friday, we saw the Swenlin trading oscillator turning back up based on price and volume. Now that we had an up day, we're seeing this turn back down. Just something to be aware of. The Elder Impulse system for the S&P has turned back to neutral after it had been negative. The parabolic SAR is still negative, and on the weekly chart we have a new negative signal, so they're confirming each other that things are turning more negative. The PMO is still going down. It's also declining based on price and volume. Our PMO study, we're still declining based on the PMOs that are rising. The buy signals are declining, and the PMOs that are above zero also continue to decline. The slope oscillator is still showing that we have short-term negative momentum. The MACD is also negative, so looking at all of our different oscillators, they're all headed lower. The bullish percent index continues to decline. It's still above 50, but since it is going down, that's more negative than positive. The NYSE bullish percent index also continues to decline, and it's still above 50. So that's positive, but the trend is clearly down right now. This is showing a little bit of improvement, the Chaikin money flow. After we've been declining, we turned up just a little bit in Monday's session. Can that keep going and eventually cross above zero? We're also seeing the Chaikin oscillator just about at the midpoint, so it's neutral right now. The money flow is declining and below 50. That's negative. The vortex still has the red line on top, so that's negative, even though it's flattening out slightly. The RSI showing a little bit of improvement with the 9 period, but we're still below 50, turning back up and slightly above 50 with the 14 period RSI. The ultimate oscillator did advance, but it's still below 50. That's negative. On balance volume came down to the moving average and bouncing up slightly. Our moving average studies were still declining with the 200 period as well as the 50 period moving averages. Our line studies, we came right down to this more intermediate term trend line. So far, this level is holding. Is price going to continue to go up, or are we going to fall back down through this? Just to keep an eye on the cycle, we did start a new 50 period cycle on August 1st. That was about the time we started to see some weakness in the market. Is it going to continue throughout this cycle? This cycle will then end on October 11th. Our different charts, we're still looking negative here with the hike in ASHI. The KEGI, even though it's pointing up, is still negative. The Renko continues to be negative, and the 3-line break is also negative. Looking at our different indexes, we did see more of a move up with the S&P because the mega caps had more of an influence than the equal weight S&P 500 index. Saw a little bit of a tick up in our overall ratio between the two. The Dow did have an up day. We were pretty much flat to slightly down with the transports, and we're seeing some more weakness with the utilities. So when we look at the relationship between the S&P and the transports, it's still very strong, but it turned down slightly after Monday. The ratio between the transports and the S&P were chopping sideways over the last few days. We did see a little bit of a tick up on Monday between the Dow and transports ratio. As we have been declining, that means that the transports are outperforming. Keeping an eye on the discretionary and staples equal weight study, we were up slightly with discretionary, declined a little bit with the staples, so our ratio after coming down to the 50 period moving average is bouncing back up and continues to show that discretionary is outperforming staples. The Dow still above this pivot level and pretty much chopping sideways. The diamonds, though, still remain positive with the Elder's Impulse system. With the NASDAQ, we have dropped below this S1 level and we have dropped below the 50 period moving average, although we came back up to the 50 period moving average when we closed. Is this going to be overhead resistance, or are we going to be able to break above this and show more positive price action? Also, looking at the NASDAQ with the fib charts, we haven't come back up to the 61.8% retracement level, at least yet. The new highs, new lows for the NASDAQ on a cumulative basis continue to show weakness. Our raw score continues to be negative. We're also coming back up and getting slightly above the 50 period moving average with the NASDAQ 100, and we closed above this S1 level. Is that something positive? Can the NASDAQ 100 continue to climb? The Elder Impulse system for the Qs has switched from negative to neutral. But on a momentum basis, we're still showing that the NASDAQ 100 is declining. We're getting down to the midpoint now with the PPO, and sometimes this can be a decision point. Other times we came down to this level and then we're able to turn and go back up. Is that going to be what happens this time as well? The NASDAQ 100 BPI is still below 50. That's negative, even though it was sideways after Monday's session. The small caps came down to the 50 period moving average and then went up and closed near the high for the day. Is that suggesting some strength could be coming into the market? Also seeing that same thing with the Russell 2000. It came below its 50 period moving average and then advanced back up to close above its 50 period moving average. Although the RSI continues to be negative and the MACD is also negative. The Elder's Impulse system for the small caps, though, still remains negative. And the small caps really underperformed the S&P 500, where they're declining in the short term and they're also declining longer term. Small cap growth versus value, we did see some strength when we compare them. Lately, they've been going almost down, but longer term, they're still in an uptrend. The mid caps are still above their 50-period moving average and closed near the high for the day. The Elder's Impulse system for the mid caps has gone from negative back to neutral. Comparing mid cap growth with value, we did see growth outperforming. It's been going sideways in the short term. Longer term, it's still in an uptrend. The dollar had another strong day and is back above 103. The FANG index also had a good day, but it's still below its 50-period moving average. Keeping an eye on the banks, we've dropped below the 200-day moving average with the bank ETF. We did see a recent golden cross in the financial sector, even though it was down slightly on Monday, and the financials continue to underperform the S&P 500. The regional banking ETF also had a down day when compared to the financial sector, and longer term, it's also underperforming. Looking at bonds, where we saw an increase in interest rates, which is more of a decrease in price, we're looking more negative here. The RSI is below 50 and declining. We've seen a recent death cross. We're also seeing a decline, of course, based on price, and the MACD continues to be negative. When we look at riskier bonds and compare them with more conservative bonds, people are still favoring the riskier bonds. We saw this ratio going up. But this is also a concern. We're seeing this ratio going up, and we don't necessarily want to see that. We want to see this ratio going down. So it means there's still a lot of uncertainty about interest rates. We're continuing to climb with our 3-month yield, where we broke above where we were at in 2007, and we're continuing to go higher. Our long-term charts, we're still positive with the daily special K chart, even though this is rolling over. The PPO studies, we're still doing okay in the long term. Intermediate term, we're seeing some weakness, but on a short-term basis, we are crossing back above zero. We're still dealing with this resistance line. When we look at the weekly chart of the S&P 500, we did have an up day, but we're still underneath this line. We're seeing pretty much that same thing with the NASDAQ 100. We remain underneath this longer-term trend line. We're also keeping an eye on this. This is longer-term and quite negative, where the ratio between the NASDAQ 100 and the Dow, this ratio did tick up slightly after Monday, but we're watching the bigger picture. When we topped out before, this was right before the 2000 dump of the .com stocks, and right before we ran into all this trouble in 2022. So we're keeping an eye on this to see how this plays out. An update of our possible positive scenarios saw a little bit of an improvement with the Qs to S&P. We're right on the moving average with discretionary to the S&P. A little bit of a tick up with large cap growth versus large cap value. When we look at our growth to value ratios, a little bit of an improvement with the large caps, mid caps, and the small caps actually broke above their moving average. The S&P to utilities ratio continues to go up. This often gives good support to the S&P. We're still declining, though, when we look at our 10-day average of the S&P 500 highs minus the lows. We had been extreme positive and stayed there for a while. Now we're continuing to decline. That's the negative side. On the positive side, we're still above 50. We're also looking more negative when we look at the 19-day exponential moving average of the advanced decline ratio. We've dropped below zero based on price and volume. We're also dropping below zero when we look at a broad market range of the 5-period moving average of the highs minus the lows. We're also turning down with our 50-period exponential moving average of the new highs minus the new lows, but we're still above zero. We're dropping below the moving average, which is causing the red line to go down, and we're just barely positive with our indicator. When we look at S&P growth to value, we did see some improvement, but in the shorter term, we've been going down. However, longer term, we're still in an uptrend. Looking at the staples to S&P 500 ratio, but longer term, this has been declining and often gives good support to the S&P. And then Tom Bowley came out with this, where August is usually the third worst calendar month. Energy is not hot, even though it was hot last week, where tech ends up being the hot sector, where it showed some weakness last week. We're coming into the middle part of August now, where we might see some kind of a bounce. At least historically, that's what has happened. And then he says down in here that during the summer is when growth starts to outperform value. We saw some of that on Monday, but we want to see that keep going and not just show itself in one session. So what's our outlook for Tuesday? Their earnings reports are coming down, but it's starting to slow down. Most of the S&P 500 companies have reported. The technicals are negative, and we're still below the support that we broke through last week. but we're above the 50-period moving average, which is also another level of support. We will be getting retail sales, and that's a pretty big report. We'll also get import and export prices, the Empire State Manufacturing, which applies to New York, and business inventories will be coming out. And we'll also get the NAHB Housing Market Index. We're keeping an eye on the geopolitical events. It's about inflation and interest rates, but at the same time, it's also about support right now. We're watching those different 50-period moving averages. Here's the updated economic calendar for the week showing what's coming out on Tuesday. We will be getting industrial production and capacity utilization on Wednesday, and we'll get the leading economic index on Thursday. There'll be no economic reports on Friday. The Stock Traders Almanac statistics. We're neutral to positive with the Dow. We're actually quite positive with the S&P, where we're neutral to positive with the NASDAQ. Also looking at what happens typically during a pre-election year from 1949 to 2022. The solid lines are what's been happening going from 2021 to the present time. The dashed lines are what has historically happened. We follow the green line here, which is the S&P 500, where sometimes we do see a bit of an improvement during this time. Then we see some weakness, and then sometimes we'll see some strength going into the end of the year. We're also keeping an eye on this. Seems like we've been watching this forever. Have we finally been able to get beyond this low that the NASDAQ has been setting and then see a bit of a bounce from that? Here's another chart. The purple area is the S&P 500. We follow the green line here, which is a pre-election after midterm bear, where in the month of August, historically, we tend to see some improvement going forward. We will be on the 11th trading day of the month, and I have another chart after this. This breaks this down a little bit better. We're looking at all the different indexes during a pre-election year. We're following the green one, where from the 8th trading day through the 13th trading day, we tend to see some strength. Our scenarios, we're still going with the down one. Our technicals are negative. We're below the support that we already broke, but we're still above the 50-period moving average. We're not going with the up one yet. Our charts just don't validate that at this point. We're kind of going with the sideways trend because in the short term, we have dropped below 20 with the ADX. Intermediate term, we're still trending, but it is weakening, although the green line is on top for both the short term and intermediate term ADX. Our warning signs. We did see a convergence of these short-term bearish signals. That's the weakness that we've been dealing with. Now we're starting to wonder, has it finished? Will we get some kind of a bounce from here? Longer-term trend signals on the weekly chart of the S&P and NASDAQ, they may be signaling that we're at a top, but that's going to take some time to play out. Seasonally and historically, August is not a very good month, but we are entering a potentially positive time during a pre-election year. The S&P 500 oscillators are negative, and we're also watching the NASDAQ 100, where the PPO is coming down to that zero line. Sometimes that marks a bottom for the PPO, but not always. The VIX is still showing complacency, but it's starting to climb as more fear is coming into the market. The NASDAQ and NASDAQ 100 are below their 50-period moving averages, but they're coming right back up to them now. But can we get above them again and then close above those levels? The cumulative new highs, new lows for the NASDAQ remain negative. The 3-month yield is continuing to climb above where it was at back in 2007. S&P 500 growth is weakening, but it's still in a longer-term uptrend. The weekly pivot, this is almost 3 weeks ago now that we hit that. That's when we hit that level, and we've been declining since that time. Is this downward movement finished, or is it going to continue? The parabolic SAR is negative, and also it has turned negative on the weekly chart. The vortex continues to be negative as well. And then we're still dealing with earnings season. There'll be some companies that do some reporting. On the positive side, we have seasonality and setups that remain in the background, and I covered those things in the weekly video. The daily special K chart is still positive where the weekly chart is negative. The longer-term equity put-call ratio is positive, but it's starting to turn back up, so we're watching that. The S&P remains above the downtrend channel upper line. We're still in a risk-on posture. It's showing some weakness even though it bounced up slightly in Monday's session. The S&P is outperforming utilities. The staples to S&P 500 ratio is declining. The Russell and the small caps as well as the mid caps are coming off of recent golden crosses. Small and mid cap growth continues to be positive. The financial sector has generated a recent golden cross. And now we're asking, are the 50-period moving averages holding? We came down to the 50-period moving average with the Russell and the small caps and the S&P 500. Is this going to produce some kind of a bounce, or are we going to fall through those levels? Our conclusion, we're still negative and we're below that support that we broke last week, but we're still above the 50-period moving average. In the short term, we're negative and we're slightly oversold. Are we starting to see a recovery? Intermediate term, though, we're still negative and we're still positive in the long term. Thank you. I hope you have a wonderful day, and I will talk to you in the next video.